In the early 2000s, trillions of bonds looked safe thanks to a quiet group of insurers. Wall Street called them guardians of trust, though some traders joked they insured everything except common sense. Cities borrowed billions to build schools, bridges, and highways. Investors relaxed because powerful insurers promised to repay every dollar. Those promises came from specialized companies called monoline insurers. Their entire job was guaranteeing bonds so investors could sleep peacefully. For decades, the system worked beautifully. Then the housing boom walked into the room like a cowboy carrying dynamite. Soon the companies that insured risk became the biggest risk themselves. And Wall Street discovered that safety sometimes comes with a punchline. The story begins with companies almost nobody outside finance had heard of. Yet they quietly guaranteed more than $2 trillion in bonds. Companies like MBIA and Ambac Financial Group specialized in insuring bonds. They promised investors payment if a borrower defaulted. Other firms joined the business, including Financial Guarantee Insurance Company and Security Capital Assurance. Their reputations were spotless and their ratings perfect. The concept was brilliantly simple. If a city defaulted on bonds, the insurer stepped in and paid investors. Because the insurers carried AAA ratings, the bonds inherited that trust. Investors around the world bought them with confidence. Municipal bonds rarely defaulted, which made the insurance business extremely profitable. It was almost boring, and Wall Street hates boredom. Executives soon searched for something more exciting. Unfortunately for everyone involved, they found it. Wall Street banks were creating complex securities backed by home loans. The profits looked enormous, and the risks seemed invisible. Banks like Lehman Brothers packaged mortgages into tradable bonds. Those bonds needed insurance to look safe. Other banks joined the party, including Bear Stearns and Goldman Sachs. Soon mortgage securities flooded global markets. Monoline insurers began guaranteeing these new securities. After all, housing prices had never fallen nationwide before. It seemed like easy money. In hindsight, it was like insuring a fireworks warehouse during a lightning storm. The guarantees multiplied across mortgage securities and complex derivatives. Few people asked what would happen if housing slowed down. Wall Street engineered mortgage bonds called mortgage-backed securities. These instruments were sliced, repackaged, and sold worldwide. Then came collateralized debt obligations, better known as CDOs. Even seasoned traders joked that explaining them required 3 whiteboards and coffee. Monoline insurers agreed to guarantee billions in these products. The fees were attractive, and the models predicted minimal losses. But those models assumed something dangerous. They assumed American housing would always rise. By 2007, the housing boom began to crack. Mortgage defaults quietly started creeping upward. The subprime mortgage crisis had arrived. Wall Street began realizing the insurance guarantees might actually be needed. Suddenly, the insurers faced enormous exposure. Bonds they guaranteed were tied to failing home loans. Investors began asking uncomfortable questions. Could the insurers actually cover the losses? The fear spread quickly through credit markets. When confidence disappears, financial systems tremble. The next problem involved the referees of finance. Credit rating agencies held enormous power over the system. Firms like Moody's and Standard & Poor's had given top ratings to the insurers. If those ratings changed, chaos would follow. Wall Street realized something unsettling. The stability of trillions depended on a few insurance companies. And those companies were now standing directly in the path of a financial hurricane. The real panic was about to begin. By 2007, mortgage defaults were rising faster than expected across the United States. What once looked stable now felt like a chair missing a leg. Banks began reporting losses tied to subprime mortgages. Investors suddenly realized the risk had been hiding in plain sight. The crisis was no longer theoretical. It was spreading through financial institutions like a cold in a crowded saloon. At the center of the storm stood the Federal Reserve, led by Ben Bernanke. He faced a system built on confidence that was quickly evaporating. Before him, Alan Greenspan had overseen years of low interest rates. Some critics argued those policies helped fuel the housing bubble. Now the consequences were unfolding. Mortgage-backed securities began losing value across the market. Monoline insurers suddenly faced massive potential claims. The guarantees they sold were no longer theoretical promises. Investors began questioning whether these insurers could survive. Confidence started slipping like boots on an icy sidewalk. The real danger came from credit ratings. If insurers lost AAA status, everything they insured would be dragged down. That included municipal bonds held by pension funds worldwide. Suddenly, even safe investments didn't feel so safe. Executives like Gary Dunton faced enormous pressure to reassure markets. His company's survival depended on maintaining trust. At Ambac Financial Group, CEO Michael Callan faced similar challenges. Investors were no longer willing to take reassurances at face value. Rumors spread quickly across Wall Street. Some traders whispered that bond insurers might collapse entirely. Credit markets depend on trust above all else. Once that trust cracks, the damage can spread rapidly. By late 2007, rating agencies began considering downgrades. That possibility alone shook global markets. A downgrade would trigger a chain reaction across financial systems. It was like pulling a thread from a very expensive sweater. Banks holding insured securities would face massive losses. Capital requirements would suddenly increase. The situation grew more urgent by the day. Insurers needed fresh capital to survive. In early 2008, the crisis reached a breaking point. Markets demanded proof that insurers could still stand. Stock prices of bond insurers began collapsing. Investors rushed to exit positions before losses deepened. The crisis was no longer contained to housing. It was spreading across the entire credit system. Banks, investors, and governments all watched closely. Everyone knew the next move could define the outcome. The bond insurers had become systemically important overnight, and now they were dangerously exposed. The question was no longer if there would be damage. The question was how far it would spread. Then an unexpected figure stepped into the spotlight, and he came with a very unusual proposal. His name was Warren Buffett, and on Wall Street, when Buffett talks, people tend to listen. Buffett offered to insure municipal bonds through his new company. The deal would separate safe assets from toxic ones. His company, Berkshire Hathaway Assurance, aimed to restore confidence. But the proposal carried a hidden consequence. If accepted, it would leave existing insurers holding the riskiest assets. In other words, the leftovers nobody wanted. The offer divided Wall Street. Some saw salvation, others saw the final nail in the coffin. While debates continued, regulators prepared for the worst. The system was now balancing on a razor's edge. By early 2008, regulators realized the situation could spiral out of control. The bond insurers had become too important to fail quietly. At the center of the response was Eric Dinallo. He faced a decision that could reshape the insurance industry overnight. Dinallo proposed splitting insurers into two parts, one for safe municipal bonds and one for risky structured finance. The idea sounded simple, but markets were already in panic mode. Timing, as always, was not on anyone's side. Investors were losing patience and confidence simultaneously, and that combination rarely ends well. Soon the downgrades began, and once they started, they did not stop politely. Ambac Financial Group lost its coveted AAA rating. That single event sent shockwaves through global markets. MBIA followed with its own downgrade. The guardians of safety were now officially vulnerable. Thousands of insured bonds were downgraded overnight. It was like dominoes falling in slow motion. Municipal borrowing costs increased sharply. Cities suddenly found it more expensive to build and operate. Pension funds holding insured bonds faced unexpected losses. Safe investments were no longer behaving safely. Banks were forced to write down billions in assets. Balance sheets began to look like a bad poker hand. The crisis fed into a much larger financial meltdown, and the timing could not have been worse. Institutions like Lehman Brothers were already under pressure. The system was beginning to crack in multiple places. Meanwhile, AIG faced its own crisis tied to credit guarantees. The problem was spreading fast. The financial system had become deeply interconnected. When one piece failed, others followed. The monoline crisis amplified uncertainty across credit markets. Confidence was now in very short supply. Governments and central banks scrambled to stabilize the system. Emergency measures became the new normal. The bond insurers survived, but barely. Their dominance of the market was over. Structured finance insurance largely disappeared after the crisis. Investors were no longer eager to repeat the experiment. Some companies adapted and survived. Among them was Assured Guarantee. But the industry would never regain its former influence. Trust, once broken, is expensive to rebuild. The crisis revealed a critical flaw in modern finance. Risk had been hidden, not removed. Insurance had created the illusion of safety, but underneath, the system was far more fragile than anyone realized. For decades, investors believed guarantees removed uncertainty. The crisis proved otherwise. Even the most trusted institutions can fail under pressure. And when they do, the consequences spread quickly. The monoline insurers were meant to protect the system. Instead, they became part of the crisis. It was a reminder that complexity can hide danger, and simplicity is often underestimated. On Wall Street, lessons are often learned the hard way, and sometimes they come with a very large bill. In the end, the guardians of the bond market survived, but their story remains a cautionary tale. Because sometimes, the biggest risk is believing there is no risk at all. And that is a lesson markets never quite forget.